With that, I'd just like to acknowledge the traditional owners on which we've met today. I know people are meeting right across the state and in some cases interstate, but I wanted to pay my respects to their elders past and present. With that, I'm going to hand over to Peter Tressida to give an update on Australian Super. Welcome, Peter.
Welcome, Gary. Thank you. Thanks for having me along. Look, this is not going to go for too long because there's not a lot of changes happening from the 1st of July this year. There's a lot of changes proposed from the 1st of July next year. So I'm going to touch on those. As normal, what I'm talking about is general information only. I can't be telling you what you should and shouldn't do, but I can tell you what you can and can't do. And just having a quick look in the notes, my favourite person in the audience at the moment is Daniel, a fellow Tiger supporter. So everyone knows I wear my Tiger support on my sleeve. So well done, Daniel. If I had a prize, I would virtually give it to you if I could. So what are some of the changes proposed in the budget? There's a lot more detail about that on our website. So australiansuper.com/federal budget 2021 if you want to get into some of the nitty gritty, because I'm just going to touch on the high points. Now, as I said, most of these are changing from July 2022, so a bit over 12 months away. And the biggest one that the super industry has been fighting for a while is the removal of the minimum threshold on when the superannuation guarantee kicks in. So the superannuation guarantee is the compulsory contribution that an employer needs to make. Currently, if someone earns less than $450 in a calendar month, the employer doesn't have a liability to pay super. That is going to be removed from the 1st of July next year. And that's going to affect about 300,000 people. Yes, they are low income earners, but at least a little bit of super, and these low income earners are generally younger people, a little bit of super early is going to help their end balance because of the wonders of compounding interest. So this one's kicking in, as I said, next year, as is an increase in the first home super saver scheme. Tricky to say early in the morning, but this is a scheme where if an individual puts more money into super than what is legislated, so the employer has to put in contributions, the individual puts more in, whether it's through salary sacrifice or an after-tax contribution, which they can then take out to go and buy their first home. Now, at the moment, the amount that you can put in each year is $15,000 up to a maximum of $30,000. So you've got any number of years to get up to that $30,000. The quickest you could do it is 2 years, so 15 one year, 15 the next. From next year, they're bumping that up to $25,000. Now, not a lot of people have been doing it. It's a very tax effective way of saving for a home, but there are a number of rules around taking that money back out. So if you change your mind, there are some higher taxes levied when you take that money out. The super contributions, so making contributions into super two ways, either before tax or after tax. Before tax being the employer contributions. After tax super contributions, at the moment, you've got to be under the age of 67 to make after tax contributions. At the moment, if you're over 67, you need to meet a work test. And the work test is to work 40 hours over any 30 consecutive day period. They're going to remove that and let no work tests, so you can make contributions into super up until the age of 75. So again, probably hitting the older demographic. And another one that's going to hit the older demographic is what they call the downsizer rule. At the moment, the downsizer rule applies to over 65s. They're going to drop that down to the age of 60. The downsizer rule means you can take assets. You can have whatever you've got in the bank, doesn't matter. If you sell a home, you can put up to $300,000 into super as an after-tax contribution. And it avoids some of the other restrictions around contributions that are in place. So, as I said, all those are kicking in from next year. What's changing this year is a couple of things, and they're just indexations. There's 3 indexations. One is the concessional contribution cap. So that's the level of contributions being put in on your behalf by your employer. It's currently $25,000. It's been lifted to $27,500. Anything over those thresholds is taxed at your marginal rate plus penalty interest. So it's just a bit of wriggle to give people the opportunity, because of indexation, to get more money to super in a tax effective way. And because the non-concessional cap is always 6 times the concessional cap, 4 times the concessional cap, you've got to wonder how people make these numbers up and the rules. It pushes the non-concessional limit, or how much you put into super after tax, up to 110,000. And then the amount of money you can move from a superannuation account. So super has 2 phases. The build-up phase, where you're putting money in that grows. You then move it into a super pension, and you have the drawdown phase. How much you can move from the build-up phase to the drawdown phase is raising from 1.6 to 1.7 million. Now, I'm not going to ask for a show of hands who's upset by those numbers, but it is a bit of an increase. If you've already made a transfer, so some of you may have made a transfer, there are some very tricky calculations. You don't automatically go from 1.6 to 1.7 if you've already dipped your hand in the cookie jar. And if anyone's got any questions about that, feel free to send them through to me via Gary. The biggest change, though, is the increase to the superannuation guarantee. It goes from 9.5% to 10% as at the 1st of July. So this is the first increase we've had for a number of years. It's the first increase on the way to getting the superannuation guarantee up to 12%. So over the next 4 years, we're going to have a 0.5% increase each year. There was some doubt about whether this would happen. It had been legislated, but you might have seen in the media over the last 18 months or so some agitations about whether it's the right time to have a super increase. The government backed away potentially from opposing that. So we've got this increase from 9.5% to 10%. One thing I'm just going to touch on, this is a strategy that may affect some people, generally higher income earners, and it's the carry forward rule around unused concessional cap. So there's a couple of hoops or things you've got to jump over. You can't have more than $500,000 in super as of the previous June, and it's over a 5-year period starting from the 1st of July 2019. So this is about that concessional cap may be restrictive of you getting money into super in the concessional way, in the most tax effective way. What this scheme allows you to do is bring or carry forward unused caps from previous years. So as an example, let's go back in time. In 2018-19, so that's the first year you can actually do this. I had a $25,000 cap. My employer puts in 10,000. I've got 15 left over. That 15 carries forward to the next year. So I've got 40,000. Again, my employer only puts in 10. I've got now 30 left over. That carries forward to this financial year. So this financial year, I've actually got a $55,000 cap because I haven't used some from a previous year. My employer puts in the usual 10. I put an additional 30 in. Now that 30 might have come through salary sacrifice. That 30 might have been my own money I've put into super because I won Tats Lotto or something like that. And I then make a claim of that contribution as a tax deduction. It leaves me with 15. That 15 now carries forward to the current financial year. It's added to the 27.5, and I've now got 42,500. So some people, generally higher income earners, or those people trying to play catch up super because they've got rid of the mortgage and the kids and they've got money they can throw into super, aren't aware of this rule. And your individual concessional cap is shown on your MyGov account. So if you go into your MyGov account, it actually keeps a record of what's gone in previous years and what's gone in this year. Now, bear in mind that those numbers are not always 100% up to date because the government is only using information that we pass on to them on a yearly basis or on a quarterly basis. But it'll give you a bit of a guide of whether you can use this rule. So again, just a bit of food for thought for you to think about, and of course, maybe go and get some personal advice about that. Now, personal advice you can get from us over the phone, over the internet, or face-to-face with one of our financial planners. So that was short and sweet. Not a lot of changes kicking in this year, apart from a couple of indexations and that increase from 9.5% to 10%. So I might leave it there, Gary, unless anyone's got any questions they want to quickly throw up in the chat, or because we've muted you all.
Thanks, Pete. Yeah, look, we really appreciate your support, and you've been a great supporter of our conferences and events for quite a number of years now. We won't talk any more Richmond rubbish. You've had enough of that benefit over the last 3 or 4 years.
Yeah, and I must admit, I was disappointed that we've gone virtual for this because we couldn't be face to face. But I just heard a news report; it was only 1 degree in Geelong this morning, so that made me feel a little bit better.
That's it. Yeah, we're all indoors, but it's certainly been a cold start to the day. Thanks for your time again today, Peter. We'll share that presentation and your contact details if anyone's got further questions. We'll go from there.
No worries. Thanks, Gary. Thank you all.
Thanks.